All right. Funding options for small business. We have a phenomenal group of individuals with banking and finance background. I'm going to let them take it from here. This is Dan Alberti that will be moderating the conversation. And we have Brian Simmering, Joe Benora, and I'm going to mess up your name, Bill Habermeyer. And I'd ask each of you guys just to give a brief summary of who you are before we dive into the presentation, and we'll go from there.
I'll go ahead and get started. I'm Brian Simmering, Market President for First Horizon Bank here in Southwest Florida, and happy to be with you guys today.
Thanks, Brian. How about you, Joe?
Joe Benora, President of Catalyst Community Capital, non-bank lender, mission-based organization based in Tampa, Florida.
Bill.
Yep, Bill Habermeyer, President of Florida Business Development, a certified development company based in Tampa, Florida, with operations throughout Florida, Georgia, and Alabama.
Awesome. Thank you guys for joining us. This is going to be a great opportunity for people who have or have not interacted with a variety of funding sources for their small businesses, for their real estate owned. We're excited to see what this could do for the small businesses, not just in the city of Fort Myers or Lee County, but the reason we're recording this is so that people all over the country can better understand elements of financing that they may not otherwise get an opportunity to hear and learn about, plus provide access to them and contacts. So we're going to move right into the banking side of this. Brian, why don't you kick it off and just direct Jill as to like them to move their slides.
All right, thanks, Dan. And thank you for all those who are watching this right now. This is the first step in gaining knowledge and increasing, your knowledge as a business owner on what the options are out there for you. I am the market president for First Horizon Bank and have been a commercial banker, investment banker for the last 20 years, and really enjoy Southwest Florida and all that it has to offer, not only from a community standpoint, but also from a business opportunity standpoint. So obviously today, we're going to talk about the impact of COVID on banks and how you could better prepare yourself for that next capital requirement, be it the lines of credit, being purchased your first building, second building. There's things that you need to know in there on how the banks are looking at that. If you could move the next slide. Go to the presentation, please. Page 2. Next one. Thank you. Obviously, in the world that we're in right now, there's a lot of unknowns. And in banks, we are here to manage risk. So with all the unknowns out there, banks in general are being cautious and conservative. There's just too many things that we just can't identify right now. And because of that, we're going to be looking at credits a little bit differently now. One of the things that we're doing as banks is we're looking at shorter terms. Traditionally, when you're buying real estate, when you're looking at a line of credit, there's known terms there, 12-month line of credit, 5-year fixed rate with a 20-year amortization on a loan. We're looking at shorter ones, and the reason for that is that we want to relook at the credit. We want to see the health of your business. We want to understand where you're at, not only prior to COVID, but during COVID and post-COVID, to make sure not that that you're doing anything wrong, but that we're there to help and support your needs. The other thing that is happening because of this is the unknown of what the effect will be on the banking industry from the standpoint of losses, businesses that were healthy prior to COVID, but now are not healthy. And what that's causing is capital constraints, cash constraints on banks because they're having to reserve for these potential loan loss. Again, back to the unknowns that we're talking about. We don't know them now, but in 6 months, 9 months, 12 months, we'll start to feel the real effect from COVID-19. But what that's causing, it's causing a limited product offering. And if any of you on this call right now have talked to a local bank about home equity lines, a residential mortgage, a car loan, things like this, it's a little bit different. And not everybody's offering the same things. especially when it comes to your business. There's a lot of, back to the unknowns, there's a lot of unknowns with your business. And I know a lot of you out there are wondering, how am I going to survive this? What does this look like? What does next week look like, much less 6 months from now? So because of that, there's a lot of banks that are limiting their product offerings to what they know and what they do best. Most banks are utilizing government guaranteed loan programs such as the SBA, USDA, programs like that, because it eliminates risk from the bank. We have that government guarantee that it's going to support us if something were to go wrong with your business. And later on in our presentation, Bill Habermeyer will be speaking on some of those government guaranteed loan programs that are out there. Now, obviously, as a banker, I'm always looking at worst case scenario. We're here to help support the growth of your companies today. We want to help you as we come out of this COVID-19 fog, if you will. We want to give you the tools so you know what you could do to sustain your business and even grow your business post-pandemic. The biggest key to each and every one of you that are out there right now is make sure that you have a relationship with a bank. Make sure, or credit union, make sure that you have that contact. You have that person that you're going to. The key right now for banks is existing bank customers, and I won't say preferential treatment as it says on the slide. I'm going to say it's priority. We're going to give priority to those that have a relationship with us, that have business operating deposits with us, a treasury management relationship, whatever that may be. We're going to give priority to them as we're looking at new loan requests. New transactional relationships, meaning like you're just going to the bank to get the loan, those things are going to be very limited. The bank is carrying, and I hate to keep using the word, a bulk of the risk. We need some buy-in from the clients that they're trusting in us, and they're going to bring their deposits over. They're going to bring a full relationship over, so we can help them out not only on the lending side of things, but also on their cash management or any other needs that they have going right now. Next slide, please. The big issue for us right now, we have a lot of requests. A lot of businesses are thirsty for capital. A lot of businesses are thriving during this time, believe it or not, and are looking at different growth strategies. The problem we have is, what is the financials or the cash flow that we are going to be basing our loan decision on? Normally, it's historicals. It's what has happened. It's the most current that we can get, which could be anywhere from a couple quarters lag to maybe a year behind if we're just looking at tax returns. So historical financials are no longer the leading indicator that we use for that. Current financials are. During the pandemic, we want to know how your business is now. And the only way we can help for the future is understanding the pain points that you're at right now. So we want to see how you are right now. And that will help us add value to your strategy on how we're going to get to that next step in your business strategy. The other side of it, cash is king. Liquidity and sources of capital are highly scrutinized right now when we're looking at any type of debt instrument that we're offering out there. I know that's hard to think about during a pandemic like we're in right now, where many people are struggling just to make ends meet for their basic needs. But if you are in a thriving business right now, or you are a business owner, just know that your liquidity is your backup. It's your safety. It's what us as banks are looking at as saying, okay, this is what happens if, worst case scenario. So just know that liquidity, sources of liquidity, working capital lines of credit, things like that, those are going to be highly scrutinized in this lending environment right now. The next step is really stress testing cash flow. So, as we look at what the future holds, we are thinking about, this business can cash flow this loan at X. Let's say it's 4% right now. But what if, we're managing risk, and banks are being very conservative in the way that they're going about it. They're using higher rates to test projections. They're using higher rates to test what pro formas are looking like for their business, just to make sure that we are making a good credit risk. And then again, new transactional relationships will be very limited, as we talked about before. Next slide. So here's some points for you that you can take home and you can start to work on as you start to formulate that next step in your business. Really, what can you do to improve your chances of getting approved for a loan, be it working capital, be it real estate? The first and foremost is a clear, articulate business strategy and the ways in which the business has or will adapt to the current climate. We want to know how you've been affected by this. We want to know how you have pivoted based on that. And be prepared to discuss how the business was impacted and what adjustments you made to adapt, because that is part of a standard conversation now with any type of new loan request for a business. As we talked about before, start building a relationship with a bank now that has the ability to meet your borrowing needs now and in the future. Banks do have certain types of industries that they're comfortable with. And when I say banks, every bank's going to be a little bit different. There are banks that specialize with restaurants. There are banks that specialize in medical. There are banks that specialize in the professional industry. This is the time to start building those relationships, calling the three closest banks, asking to talk to a business banker or a commercial banker, and just asking them, where's your credit appetite right now? That would be a great first step. And then once you begin that relationship, start talking about how they're going to look at your new loan request. Even if it's 6 or 12 months, or you don't even know really when that purchase is coming or when that line of credit need is, you need to understand how they're going to be looking at your cash flow and how they're going to underwrite your loan, so you can prepare yourself not only from the capital needs that you may need from a down payment for a new property, but also liquidity necessary to sustain, even if you do have working capital lines of credit available to you. That's really the biggest takeaway I want everybody on this call to know, is that you have to have a relationship with a bank in this environment right now. People coming off the street, don't know anybody, don't have a relationship, no checking account, that's not going to be the highest and best. That is not going to be the easiest road for you. If you have an account at First Horizon Bank, for instance, you need to call your banker at First Horizon, and you need to talk to them about what your future looks like, what you want to start planning to do. Use them as a consultant. Use them as an advisor. There's a lot of good benefits that come from that. Next slide. And that does finalize my presentation. We are going to have a Q&A at the end for all the presentations. So without further ado, I'm going to hand it over to Bill Habermeyer, who will go over some of the government guaranteed lending programs available.
Yeah, thanks, Brian. I thought the information that you provided there was a great setup for what I'm about to go through as it pertains to SBA programs. But I do want to applaud you and your bank for utilizing the government guaranteed programs. There are still quite a few banks that they just fundamentally don't participate in government guaranteed programs, and it's really kind of a disservice to their clients. As an SBA lender, we clearly understand the value of our banking partners. It's a complex economy. There needs to be a strong banking system. There needs to be good SBA lenders. There needs to be good non-bank lenders like Catalyst and Joe Benora's firm to make this thing work. And the more that we're open-minded and communicative with one another about what might actually benefit the small business community, the greater the community is going to thrive as it comes to access to capital. So with that, I'll go through, next slide, please. A couple of the SBA programs that are currently available for the recovery. Many of you on this call have heard about the Payroll Protection Program. This program was put in place very quickly and has received a lot of media fanfare, good and bad. But I think the intent of the program was to really provide the assistance to the small businesses that were forced to lay off employees right when the government basically shut down the country. So these loans were applied for, they're applied through banks, they're applied through companies like ours, and they're tied to what your payroll expenses were over the last year, but these loans are forgivable. If they meet certain criteria and they don't have guarantees, there's not interest that's paid on them for a long period of time. And they're a powerful tool for many businesses to get money back into their employees' hands in lieu of having to go to the unemployment, some of the other state sources. This program started at, and correct me if I'm wrong here, gentlemen, at the end of, or the middle of April. There's only 2 weeks left for you to apply for some of these loans. And there's still quite a bit of funding that is available. Originally, there was 330 billion in the country that was used in about 2 weeks. The Congress authorized another 330. And as of today, there's about 180 billion left, but only 2 weeks left to apply. So there are a lot of good resources out there. If you have trouble understanding some of the rules, SBA programs are very detailed, but there are a lot of resources that are in your local communities that can help you apply for these types of loans. And again, there is money left. Yes.
I apologize to interject. You say 2 weeks left. People don't specifically know the date possibly that is on here. What is the date that will end as far as application process?
Yeah, great question. Last day of June.
Thank you very much.
Sure. Next slide, please. So the second recovery piece within the SBA's cadre of programs right now is this economic injury disaster relief loan. So this is actually a loan, whereas the PPP loans are called a loan, it's designed to be forgiven. This is actually a low interest rate loan that you can get up to $2 million. The first 10,000 of that 2 million is a grant. It is designed to be that. You don't have to pay that back. But the interest rate and term is extremely favorable. You've got an interest rate for for-profit borrowers at 3.75. That is a 30-year loan. So if you got the max of $2 million, 3.75, 30-year loan, those are pretty favorable terms that aren't available in many of the banking sources. You also don't have to pay interest for the first year. So another great program that the SBA put in place relatively quickly to try to stem the tide of the pandemic, reaching all the way through shutting down businesses. So
Bill,
this program,
nonprofits are eligible for this as well, right?
They are, and actually they get a reduced rate. Their rate is 2.75. So it's a great benefit to nonprofits and for-profit businesses. Next slide, please. Okay, as Brian touched on briefly, the banks, well, all of us want to see an end to this. We all want to see businesses regain traction, grow, thrive. And the first two programs that I talked about, I think are a component of the recovery and what we're trying to do today. So as many people hear me say, especially my employees, we want to be a part of the solution today, and that's our recovery initiatives, but we also want to be a part of the solution for the future. And the Community Advantage program that we offer, while it might be a part of helping today, it's really designed for the future. And that is a loan for up to 250,000, and it can really finance just about any normal business purpose. But it is designed to reach businesses that are located in underserved areas. Obviously, banks have their own algorithms that tell them where they're going to lend and where capital might, where there might be more risk. And so this SBA Community Advantage program is really targeted at these underserved areas. It's a program that it's only administered through certified development companies, and that's what Florida Business is, a mission-based nonprofit lender, and we operate in Florida, Georgia, and Alabama. But for those of you that are not in the Southeast, there's a network of CDCs throughout the country, over 200 of them, and we'd be happy to point you in the right direction where you could get these funds. The rates are pretty favorable. Typically, it's prime plus 2 to 4%, and the loan term can be 10 years for working capital or 25 years for asset purchases. But we would guide you on what would be most advantageous for your firm. Next slide, please. Yeah, the last loan program that I'm going to talk about is actually Florida Business's core business. And this is really designed to be a part of the recovery. The typical, it's called the SBA 504 program. The typical use of proceeds is the acquisition of real estate and equipment. When you utilize the SBA 504 program, you don't have to put a very large down payment down, and you also have access to long-term fixed rates. So that's the basics of really wealth creation for a small business owner. Obviously, you're able to make money selling your widget, but if you really have the ability to buy real estate, and it makes sense in terms of a cost perspective, long term you can really build wealth and focus on creating and accumulating that wealth over time. It is really a powerful tool to not only help the local economy in the near term, but also to help yourself build wealth time over time. The loan amounts are a lot different than some of the other SBA programs that I mentioned. We can participate in transactions that are up to $15 million. The average SBA 504 loan is about $1.5 million. And not to get too into the weeds here, but it is in partnership with a bank like Bryan's Bank. So the bank would provide a piece of the debt, and we would provide a piece of the debt. In concert, you get a smaller down payment, and then the SBA loan rates are extremely low based on the bond market. So, and our current bond offering right now, or the rate to a small business owner, is 25-year fixed, and that's 2.6%. So the terms right now, extremely favorable. And again, the SBA 504 program is one that can really help build wealth and be a part of the solution going forward.
Bill, I know we're going to ask a lot of questions as we come into, but while we're diving into this use of funds, can this be used to purchase a business that has real estate?
It can, but we would have to carve out just the real estate.
Okay.
So we would, that's something that we would provide guidance on if we would have to change the contract to specifically delineate what's going to be a part of the real estate and what's going to be the business acquisition. And then we can provide other sources of capital in those areas to try to facilitate that transaction, getting the most advantageous terms.
Very good. Awesome. Bill, awesome presentation. Great content. Thank you. We're going to move to Joe Benora with Catalyst.
Yeah, thanks, Dan. Hi, everyone. So what I'll be talking about today is for those of you that are small business owners or micro enterprise, which is defined as 5 or less employees, including the owner, some of these options may seem to you as out of reach. So maybe you've been to your bank before, you've tried to get financing from your bank, and for whatever reason, you didn't qualify. That could have been for credit, that could have been for lack of historic financials, or any number of reasons along those lines. And so what do you do when a bank won't finance you, or the company's too new, right? And that happens a lot as well, when you have a newer company, it's been in business, 1 or 2 years, but you need financing for growth. You don't necessarily want to sell equity in the company or bring in a partner. So what do you do then? So what I'll talk about is alternative sources of funding, right? So non-banks. Go to the next slide, please. So when I say alternative funding sources, I've listed a few here. There are more, but these are the general categories. They refer to lenders such as us as non-bank lenders, so non-depository or non-bank. We don't take deposit accounts, generally funded by banks or other sources of capital that'll give us the funding that will then be used to fund small businesses. So this category includes fintech or financial technology companies. You may have heard that term. It's been a buzzword, or specialty finance companies. These companies like Newtek or ReadyCap Lending, and you might have heard of like Kabbage and some of these other ones that you see, they are on debt capital. These companies provide a little more flexible source of funding, generally smaller transaction sizes. And then you've got asset-based lenders. So asset-based lenders are going to be those finance companies that focus primarily and almost solely on what you're pledging as collateral. So it could be accounts receivable, it could be equipment, it could be real estate. And then finally, you've got mission-based lenders such as like us, Catalyst Community Capital, we're referred to as community development financial institutions. We're an emerging one. There's a lot of large ones and a number of smaller ones around the country. These are mission-focused, mission-based organizations, really focused on community development and economic development. So a primary mission of a lot of CDFIs is funding small businesses that wouldn't otherwise qualify for financing. So you've gone to your bank, they weren't able to provide financing, many times for regulatory reasons because of the credit underwriting standards. And so we partner with banks to provide funding for those businesses in the hopes that, you know, we will be the first source of capital that will then bridge you to a point where as you grow your company, then you can go back to a bank and get maybe more favorable terms. Next slide, please. So I'll go through the benefits, some of the up and downside of each. So with fintech and specialty finance companies, again, you know, they're faster. You've gone to a bank. If anyone who's gotten a bank loan in the past, Brian can attest to this. I'm sure Bill can as well. There's generally not a quick no. Sometimes there are, but a lot of times you go through the process because they're trying to help you. They want to underwrite your deal and get you a loan. And usually it's 30, 45 days. And then once they've gone through all the information, to the extent you don't qualify, then you'll get a denial. And so with that, you'll, you know, you've now spent a month and a half, and you've ended up with no funding. So the benefit of these fintechs or specialty finance companies, many times they'll be able to give you an answer quickly. And in fact, some of the fintech companies can give you an answer in 30 seconds. It's pretty impressive how technology is being used to automate and expedite the underwriting process. They'll also use an alternative credit scoring model. So what does that mean? That means that maybe you don't have a personal credit score, or you've got limited credit history, or maybe some derogatory credit history. Again, what they're using technology for these days is amazing. And they're looking at alternative indicators of credit worthiness, both the ability and the willingness to repay a loan, things that are so kind of outside of the normal box of credit underwriting, things as you know, your consumer spending habits, travel history, you know, social media posts. I mean, they're looking at all kinds of information that they aggregate to then determine whether or not you would be a good candidate for financing. So, and they'll also use other alternative trade lines such as cell phone bill, utility bills. If you've been paying those bills on time, they can take that into consideration. The underwriting process is easier in that they won't necessarily require all the things that a bank would, such as your tax returns, audited financial statements. They may be able to do it with as little as just your credit score, some internally prepared income and statements and balance sheet, and they can turn it around a lot faster. The downside, so you know, what's the negative here? When they're taking on more risk, and you'll probably hear this as you talk to funding sources, the more risk that's taken on by a lender, the more return they're going to require to help offset some of that risk. So what you're going to end up with is you may have an expedited underwriting process, but in exchange for that, you're going to pay a higher interest rate or more fees. In addition to that, shorter loan terms. You know, they're mostly designed many times to provide, you know, call it bridge funding to get you through the first 12 to 36 months of getting your business up and running. They're not designed to be long-term sources of funding in most instances. So they're going to give you a shorter loan term, meaning that in 24 months, you might have a final payment due, or you'll have a shorter amount of time to spread your payments over. So that's the downside. Asset-based lenders, The next category, again, they're going to look at more of the collateral versus the actual credit. So it's not so much the credit worthiness as much as what you're pledging as collateral. So if you're a startup or maybe you've been in business 6 months, you've got some good customers, they owe you money, your customers do, you've got some accounts receivable, but you don't have the cash, but you can pledge those accounts receivable. They'll take that as collateral, really not look as much on your credit or your company's financials because they have that collateral. They'll quickly process and fund the loan just like a fintech or specialty finance company. So speed is definitely a benefit. But again, with that risk and the fact that they're not doing a full credit underwriting, you're going to pay higher interest rates and fees to compensate for that risk. I said not typically customer service focused. That's probably not a fair assessment of all of them, but you may find that some of the they call them hard money lenders or asset-based lenders. They really they're not there to build long-term relationships. They're really just transactional in nature. So you might not get the kind of treatment you would get from someone like Brian, where you go to his bank and you have a relationship manager. You're going to get you need the money, give me the collateral, I'll give you the funds, pay me back as fast as possible. And that's more the approach you will come across. Again, it's not a blanket statement across all asset-based lenders. There's plenty of them out there that are very good and are customer service focused, but just making you aware that that may be something you encounter when dealing with those types of lenders. Finally, CDFIs, again, community development financial institutions. CDFIs are certified by the Treasury Department. That is a regulated entity that they're accountable to low and moderate income communities. And so CDFIs, again, community focused. So the primary purpose of a CDFI is to help revitalize communities through a number of things, including housing, economic development, job creation, and empowering people to become their own business owners, become self-employed. And so CDFIs, because they are mission focused and mission based, and many of them are nonprofits, the benefit of CDFIs is that they're getting funding from banks that need CRA credits, from grant makers that are looking to give grants to people that have a mission of both, again, community and economic development. And so lower cost of capital. And because of that, they're going to be able to provide funding at a lower cost. Also with community development financial institutions, CDFIs have a mandate to provide technical assistance. So what does that mean? That means that beyond just getting a loan, and many of you might have experienced this or maybe been thinking this, you give me the money, that's great. I don't necessarily know how to run a business. So now what do I do? How do I account for this? How do I book it? How do I actually grow my business? So CDFIs provide technical assistance that helps business owners do just that, right? How do you fundamentally set up a business where your accounting is correct? How do you prepare yourself for down the road as you grow for bank financing like Brian mentioned earlier, right? How do you prepare yourself for that underwriting? So CDFIs provide critical technical assistance that'll help get you through the initial years, which are the toughest for small businesses. What's the downside? There's in Florida in particular, there's a limited number of CDFIs, so they're not out there in the market. You don't see them a lot. They're mission focused, so sometimes you'll have a mandate or the CDFI may only be able to focus on or fund businesses in certain census tracts. They might only do minority-owned businesses. They may have certain other limitations that reduce the size and scope of what they can offer up because of that mission. So that's the downside. These categories really are the main ones. Again, there's other sources of funding out there. You might have friends and family. There's crowdsourcing, so you can go online. There's plenty of places to find capital. These are the main ones. These are the more, what I'll say is institutional sources of money, meaning that these are institutions that have a pool of capital ready to be deployed and funded. So outside of this, there's plenty of other places to go for money, but for purposes of this webinar, we'll just limit it to these three. Non-bank lenders work with companies like Bills. So we've done hundreds of millions of dollars over the years of SBA 504 loans, where we as the non-bank lender provided the first mortgage loan and Bills Group provided the SBA second. And it's a really nice fit because many times we were referred our borrowers by banks that had taken somebody through the underwriting process and for whatever reason couldn't get there. Bills Group has an SBA approval. And so now they need somebody to provide that first mortgage loan. And again, maybe that loan itself is not bankable per se. It doesn't have all the criteria that a bank's looking for, but for us, it fits the mission. There's a low loan to value because we're in the first position, and so we'll take that risk. And so non-bank lenders work very well with the SBA and SBA CDCs like Bill's, and also with banks. So we would partner with banks like Brian's bank, like First Horizon, where maybe that you're requesting a loan that's the bank isn't comfortable advancing that full amount, so we could partner with them to provide some additional support to get the deal done. So that's it on mine. That's the last slide on my piece of it. So probably ready for questions now.
Yeah, Joe, before we dive into everybody's questions, can you scroll back up just to one more slide, Jill, to the last slide. For each of these categories, if you're a small business of 0 to 5 employees with under $1 million of revenue, is it possible that I could work with all 3 of these different potential lenders?
Absolutely. Yeah, definitely. Again, the fintechs and the specialty finance companies have really targeted the business that you just described, right? So it's generally the smaller companies that need 50,000, 25,000, 100,000. So they're a good fit. The asset-based lenders, same thing. You've heard of factoring companies. Maybe you have 100,000 of accounts receivable. You need short-term working capital until you receive those payments. So you need 50,000, same thing. And CDFIs, many CDFIs are micro enterprise lenders, which is another SBA program, but even without the SBA, it's a funding program that's out there. Typically 50,000 and under for the loan amount for companies that are 250 to $1 million and under in revenue.
Awesome. That's great. Well, we have the Tessa Lesage with the Community Foundation and with 12 other amazing organizations that she's involved with here to help facilitate some questions that we might have both from this group and from others. If you have a question, if you are on this call, there is a button at the bottom of the presentation that says chat. You can type in a question to Tessa directly or to anybody else on the group, and we'd love to answer any specific questions that you might have. So I'm going to turn this over to Tessa.
Thanks, Dan. We have a few questions that came in prior to the event and some in the chat, so I'll go ahead and get started. Brian, for you, what does shorter term mean, and what happens at the end of the term, and how would one qualify to extend?
It's a great question. Term is the period in which the fixed rate is in place, and basically the term would be when your loan would mature or balloon. And how would they qualify to extend? Whatever the underwriting criteria are at that time. I mean, it's going to be cash flow, loan to value. If we're dealing with real estate, going to be looking at the health of the company. And the reason that we do the shorter term amid the pandemic that we're in right now is really just to check the health of the company and make sure not only they're okay, but we're adding all the value that we can from a product and service base for them.
Okay, thank you. That's great. Bill, we have a question for you. So are there loans that can be used for growth-oriented efforts, meaning buying other companies or building out space, but not owning real estate?
Sure. The Community Advantage loan that was discussed, that loan can be utilized to purchase companies, and as was on the slide, really for any business purpose, but one of the popular use of proceeds within that program is to buy companies. Leasehold improvements, where you don't own the real estate, would also be a use of proceeds that we would consider within that program. And our business development officers are aware of all the various programs. So even if it's something that doesn't fit our credit criteria, we would be referring to banks or to Catalyst, because there's a lot of sources out there for stuff that really would fit in our box.
Okay, and that kind of leads to the next question, which any of you can answer. So what would you recommend in terms of finding the right person or program for my specific company?
I would say, the names that are up here on the presentation, Florida Business Development Corporation, if you think that, down payments are going to be an issue and that's something that liquidity, I should say, I would contact them directly. They know who they're partnering with on a lot of these programs. They know what the appetite risk is for the different banks. That would be one route. The other route would, if you have a banking relationship, talk to your banker, even if it's just a depository relationship, discuss with them and see what the opportunities are with their bank for your company. And then outside of that, there are, here in Southwest Florida, the Small Business Development Corporation at Florida Gulf Coast University is a great resource for those that are either starting a new business, thinking about starting a new business, to help out from that consultation standpoint of building business plans out and things of that nature and business strategies. So, they have the resources here on this slide to figure out what the right company is.
Thanks,
Yeah,
Brian. Anyone else want to add? Joe, you want to add to that?
Yeah, I think Brian hit it. I mean, the Small Business Development Centers, the SBDCs, also the Economic Development Office for Lee County, for Southwest Florida, or in the cities in Cape Coral or Fort Myers. The group on this slide here can certainly help, but there's plenty of resources out there. I think we help out a lot. Even like the PPP loans. There was a lot of confusion as to who to reach out to if your bank's not doing it. So certainly you can utilize us as a resource. My contact information is there. But those other groups, like I said, SBDCs, I think Goodwill, Second Muse, Florida FGCU, there's plenty of resources there to help point you in the right direction.
Yeah, and just to finalize things real quick, I mean, the first question everybody at our company on the sales side asks small business owners, who do you bank with? So for all those business owners that don't have a relationship, reach out to your local banker and start a relationship today, because that is paramount to them giving you the first line of assistance. And even if that's just depository, at least you can start there. But that is the first question that we ask anybody that's contacting us. So it's really important that you start that relationship now.
Hey, Bill, that leads me to a question. A lot of people have not done a lot of banking. They may have a deposit relationship with Wells Fargo or one of the huge national banks. And this is not to provide any discredit to the large national banks. Brian's bank is a large bank, but also very different than possibly a retail bank. Could you direct as to how do we find or identify the right types of banks that can fully act as a community lending institution?
Yeah, I mean, I would just go online and Google, a bank near you. You hit the nail on the head. There are large national banks that have vast branch networks throughout the country, and they're great institutions. They provide a lot of value. But if you're not getting the customer service that you expect, or the same type of expectations you have in dealing with your customers, it might be advantageous for you to reach out to a bank that you might not see TV commercials on, a local bank or someone that you might have just Googled, a bank near me. And I would say that try to have a real conversation, a sit down with someone in person or virtually in the current time that wants to understand your business. But would you think that's good advice, Brian?
Brian, you got to unmute.
I do some of my best work on mute. I apologize for that. I would just say that maybe a first step before the Google would be talking to their peers in the industry, other business owners, see where their relationships are at, and see if you can get a warm intro, because referrals to banks with a peer group that is very similar to your risk and your needs, that's very important, because, we have lots of options out there. We got everything from community banks to credit unions to regional banks to, the large nationals. And each bank can do a lot of the same stuff, but it's not tailored for the specific needs of each business owner. So ask your friends, ask your other business owners and peers, see who they bank with.
Yeah, Brian, I think that's super helpful. We don't rely enough on our peers sometimes and look to them as a resource. Along those lines, I have a question for you about what is actually considered a relationship with the bank? You talked about this extensively, but could you sort of review for us what you would say is a relationship with the bank, and how do you, I mean, we've talked a little bit about how you start one, but if you didn't have one, what's the, when you walk into the bank, what's the best way to go about that now? And you have to unmute. I know you're giving us such good information. We can't hear you.
Yeah, it's checking accounts. A personal checking account, business checking account. That's the easiest first step. That gets your intro into the bank, gets you in front of someone in the branch, and then really when you're going in there to do that, request to talk to a business banker, a commercial lender, someone who does business lending, so that you can start to build that knowledge base and what that bank's looking for, and see if they're interested in your business.
Tess, I'll add to that as a borrower when we do our developments and any other type of financing. Again, like I said earlier, groups like ours, we get financing from banks to then provide financing for businesses. Relationships are huge. It always comes up. I mean, to have an existing relationship with a bank goes a long way. When you just call out of the blue and they don't know who you are, it's really tough. And especially if you're a small business that you're not bringing $1 million, deposit account with you and a huge need for funding, it's really tough to get that attention. So it is paramount that you establish relationships with banks and find the bank that fits, the business you're in, where you're located. Sometimes community banks are a better fit for smaller businesses. Sometimes bigger banks are a better fit because they have more services they can provide, or they have more of a technology platform. So really pick the bank that's a good partner for the business.
Great, thank you. I have a couple more questions related to things that we did specifically talk about. So where can small businesses apply for the Paycheck Protection Program and some of the SBA programs that were mentioned throughout the presentation?
The PPP loans, we work with Bill's organization to help facilitate those. So they can, we'll send a link out after this to the application page for the PPP loans. And the EIDL loans, Bill, they're going directly through SBA. Is that correct?
They are. We have a link on our webpage to all COVID related resources, and there's a direct link so you can go to the application. It's at the SBA's website. But that is a direct application with them.
Yeah,
okay, thank you.
Those are the programs you're referring to, the questions for the emergency relief ones? Correct,
yeah. You talked about a lot of programs. Just wanted to make sure we close the loop on where people access those. So thank you.
Yeah, and so, Tessa, real quick, and SBA.gov has lots of information on it, on all the different lending programs. It may even be best to peruse that prior to reaching out, just to kind of see if this is even for your business or even advantageous for you. So a lot of great resources out there.
Thank you. That's great advice. Okay, so we're going to move on to some different questions. The first one is, if I want to buy the unit that I'm leasing, how much of a down payment do I need to get financing, and what are my options?
Sounds like a Bill question.
Yeah, if you don't want to put much money down to purchase that real estate, the 504 is the best option. We only require, if the business has been around longer than 2 years, we only require a 10% down payment. So that would be the best option there, and coupled with the 25-year rates in the 2.5% range, that's probably your go-to right now if you're going to buy that unit.
Yeah, with rates like that too. For anybody who, if you're a homeowner, you always hear the term it's cheaper to own than rent. It's almost like that in commercial real estate now. I mean, if you're leasing space, there's a good chance that if you're buying owner-occupied real estate and using a 504 loan, at those rates, your payment could quite possibly be less than what you're paying in rent. And it's a big issue. Everybody keeps hearing about the wealth gap and how do you build equity and build wealth? And this is a good way of doing it. If you're staying in the same place for 10 years, you can start accumulating some real good equity in it by buying the unit.
Yeah, and that real quick, if you are in the market to buy something in the next 2 months, because of the CARES Act that was passed by Congress in March, your loan payments on your SBA loan are made for the next 6 months, as long as you fund that loan before September. So I know that's a short horizon to get things closed, but it can happen. And so not only do you get that low rate, but the next 6 months of your SBA payment are actually made for you. They're not deferred, they're made for you. So if you can move pretty quick, it's a pretty good time to be an SBA borrower right now.
Wow.
Bill,
And
from
the good
sorry,
good thing
Brian.
good thing about that for the small business owner is that the liquidity required for the down payment can sometimes seem insurmountable. So with the enhancements that the SBA is providing, they can recoup that cash over that 6 month period. So that's kudos to the SBA for that.
There's and one thing to add, Bill, you could speak to it in terms of how the guidelines for it, but the down payment, that 10%, it can come from borrowed funds, or it can come from another source or seller financing in some instances. Is that right?
Yeah. We do want to see, just like any lender, that there is liquidity available, but Brian brought up a great point. If they're light on liquidity and they want to find some alternate sources to provide that equity, we're going to be advising you on what makes sense, not only to get an approval, but also to help your business in the future.
Okay, thank you. So the next question is, how can I expand my business into other locations?
Is that a funding question? Is that a strategic question?
The next question is about developing a business plan, but this, I believe it's a funding question. So like if I want to get into new space, I mean, it specifically references malls, so I don't know if that helps, but how can I bring my business to other malls or other places?
I think you're it'll probably answer the next question too with the business plan. I think that's from a lender's perspective, we're going to want to look at any expansion, how that expansion, does the business support it currently with the cash flow, and many times it doesn't. So we're going to want to look at projections, but really a good business case for the expansion, right? I can tell you, as I've been a small business owner for most of my career, and sometimes it sounds good to expand, but it doesn't always make sense. And so as a lender or somebody providing funding, we're going to want to look at, all right, why did you decide to do this? What's the strategic advantage? What's the, how much capital is going to be required? The use of those funds, and expanding sometimes is the same thing as starting a new company. So that usually means that it's going to take twice as long and cost twice as much to get it done. So we'd be looking at liquidity, working capital, and the timeline and the projections provided. And we're going to do, like Brian referenced earlier, stress testing. We're going to look at that and make sure that there's enough room there, enough margin for error in the event that, you don't get the projections, you don't hit exactly what you expected, which 99% of the time, I'd say. I've never seen projections get met.
Me neither.
I've never seen a set of projections that showed losing money. So, but it happens. So it's just things to keep in mind. But that's from a funding perspective, how we would view expansion. So the business owner's plan should be really working through almost like a new business plan, just to vet any of those potential issues and make sure that it's a good plan before you go to a lender. You should have all that prepared. And for technical assistance, like I said earlier, to CDFIs like us, we can provide that technical assistance. So we could do a review of the business plan, help out, do some kind of sanity check if necessary to see if that they really are realistic.
Joe, to that point a little bit on the business plan and the finance side of it, I would challenge and encourage people to not be afraid to go into banks and get told no to learn also. So to work on those business plans and allow bankers and finance experts to be able to poke holes in things, go refine your business plan and come back, and know that there are enough banks to keep getting turned down to then find a refined business plan so that you can execute. on that. So using finance and gentlemen like yourselves to gain greater knowledge is helpful.
Yeah, it's a good
All
point.
right. Good strategy.
And just to jump in real quick, you know, I know Brian was talking about things to be prepared for, and you know, when we're looking through business plans, I know it's extremely off-putting for anybody in the finance seat when you ask them how much money they need and they say, well, how much will you give me? You should really have it dialed in how much money you're going to need. Obviously, it should be based upon your preliminary assessment of where you sit. But it'll help the dialogue with the bank or SBDC rep or business development officer from our firm if you've even at least got a starting point to where you can refine. But that is not going to lead to a step in a positive relationship if you don't know how much money you need to start off. Yeah.
Or another thing that you'll see, we hear this quite often, is they want 200,000. You maybe not able to do a 200,000 loan. They go, well, I'll take 50,000.
Right.
You need 200,000. 50,000 is only going to get you. It's only going to set you up for failure. You don't want to be underfunded, right? So if you can't get the amount that you really need, then you maybe it might be longer before you can actually execute on that plan. But you don't want to be underfunded. It's the worst thing. It's the number one cause of businesses failure is just they go in undercapitalized and they just run out of money before they thought they would.
All right.
Great.
Team, we have hit the hour mark, and I know we plan on doing follow-up conversations around this. Are there any last-minute statements that you guys would like to provide to those listening?
Yeah, I would just say stay positive. This is going to be a short-term situation right now with this pandemic. Brighter days will be coming. There's a lot of different schools of thought on, how long the recession will last. Are we in it? Are we out of it? Whatever. Concentrate on your business. Concentrate on what you do every day and how you make money, and utilize the resources that we've gone over here. Utilize the resources that are around you and have conversations. I learned so much in my career, not because people taught me, but because I asked and I wanted to know. That thirst for knowledge will be very important in establishing a relationship with the bank and understanding the current economic environment and what the future economy is going to look like.
Yeah, well said.
Yeah, I agree with that. I think the other thing I would add is, don't let any kind of pride get in the way of you asking for help or for resources that are out there and available. A lot of times as business owners, try to figure everything out on your own. You don't want to ask for any assistance. And the reality is that everybody, like the people that are on this right now, this presentation, everybody's available to help, and that's what we do. So don't feel bad, don't feel embarrassed about being in a situation where you need assistance, getting funding or answering questions. That's what we're all here for.
Tessa, Joe, Bill, and Brian, I know you all personally. You all put your pants on one leg at a time, as my grandpa said. Very human, very engaging, and I hope everybody on this call, and as you guys get to know finance oars, will start to learn that they're people as well, and want to see you thrive. So thank you again, everybody, for joining us at this presentation on finance and small business. We look forward to bringing more of these to you, and have a wonderful day.
Thanks, Dan.
Thanks, everybody.